Hi there folks, Bot Evans here. Today we want to discuss the reasons why buy-term invest. The difference is a theory that doesn't hold water. The problem is this: it is a psychological fact that it is impossible for young people to visualize themselves as older people. This causes young people to make choices, which in retrospect often turn out to be poor choices. We are going to share 3 cases with you from an associate's case files. But first, here is just a simple overview. Those that bought term and were going to invest. The difference didn't simply do it. They bought term and spent the difference. And the few of those that did invest the difference, a good portion of them lost it in poor investment choices. Case 1. After a long career, John and Jen, husband and wife, retired. They had no children and had repeatedly rejected recommendations to purchase permanent life insurance, citing Jan's large amount of group term as the only insurance they will ever need. Jan had a generous pension. John had none. They selected the no refund option on Jan's pension because it, along with Social Security, would allow them to live the lifestyle they wanted. It was recommended converting the group insurance so that John could maintain that same lifestyle in the event of Jan's death. They simply felt they couldn't afford it. They moved to Florida, bought a beautiful condominium and joined a country club. For 2 years, they played golf and enjoyed retirement. Suddenly, Jan became ill. She passed away within a few months. In addition to the incredible trauma of Jan's death, John found he could no longer afford the condo or the club. He was devastated. The permanent life insurance that was recommended would have allowed John to remain in his own world. Case number 2. Several years ago, a 55-year-old, we will call him Dave, had amassed a substantial amount of real estate assets. His son was in business with him and he wanted the son to be able to continue the business. In view of the lack of liquidity, $3 million of life insurance was recommended for estate tax purposes. Dave agreed to the life insurance, but because of cash flow problems, he preferred to purchase term insurance, which he would convert within a couple of years as he promised. Every year as he was recommended to convert the insurance, but the cash crunch seemed to continue. The conversion privilege expired at age 60. At age 63, Dave was diagnosed with cancer. When they met to discuss his situation, he inquired about the insurance. I told him it would expire at age 65. He asked, "Are you telling me I have to die before 65 for my family to get the estate tax money?" When our associate responded in the positive, Dave said, "I've paid on this policy for 8 years. There must be something we can do to keep the policy in force. Whatever it costs, I'll pay." Dave died at age 66. The real estate market was in a downward trend. The family sold most of the real estate at bargain prices. Permanent insurance would have provided the required money for pennies on the dollar, and the taxes would have been paid for the estate instead of from the estate. Case number 3 is a personal story of our associates. His father owned term insurance. As he got older, he was upset with the ever-increasing premiums. He had built a good-sized estate and felt that his mother had enough assets if he should die. Reluctantly, he dropped the term insurance. Subsequently, she developed Parkinson's disease. 3 years later, his father died. His mother fought a valiant battle against this terrible affliction. Ultimately, a nursing home became necessary. She was a private person and wanted a single room. Subsequently, she required a helper 8 hours of the day. The annual cost of the home and helper was $105,000. As the disease progressed, she became incontinent, had to be fed and could barely speak. A very proud person had lost nearly all her pride. One thing sustained her self-esteem though. The bills were being paid with his father's and her money. Regularly she would ask, how is her money holding out? He never told her that if she lived a few more years, it would all be gone. Even though his mother died leaving some assets, permanent life insurance, which would have been enforced at his father's death, would have assured her financial security should she have lived longer. Dr. Solomon Huebner was correct when he said, permanent life insurance is the greatest product ever designed by the human mind for the solution of financial problems. We appreciate you watching. Please feel free to check us out online at www.evansfinancial.com or on Facebook at www.facebook.com/Evans Financial Shreveport. We hope you enjoyed our insight.